Hello, I'm David Chow from the Finance News Network. So joining me today from NAB Asset Management is Portfolio Specialist and Senior Economist Bob Caneen. Bob, thanks for joining us.
Thanks very much for the opportunity, David.
How is the Australian economy performing in 2016?
At this stage, the Australian economy is doing reasonably well because we are transitioning after the mining investment boom. If you looked at the March quarter real GDP result, the economy grew by plus 3%, which is quite solid. It's really around trend growth rate, so around the average growth rate. And what you saw in the components, you had solid consumer spending, strong housing construction, as well as favourable net exports. Now, this has offset the mining investment downturn. So this is encouraging. It shows that the Australian economy is quite resilient. Now, some of the recent data has been quite mixed. We've had softer retail sales for April and May, but that largely reflects price discounting. So if we adjusted it for inflation, so the movement in prices, we could actually say that the consumer spending data in terms of retail sales has been reasonably solid. The labour market's performing well. So if you looked at jobs growth for May, nearly 18,000 jobs were created, and the unemployment rate is steady at 5.7%. So that's a reasonably good number. When we look at the business surveys, if you looked at the May NAB business survey, you can see that business conditions are quite favourable. So that indicates that there's considerable growth momentum in the Australian economy. So we're doing reasonably well.
Now on to Brexit. What will this mean for the global economy?
Well, Brexit is a concern because Britain's decision to exit the European Union throws into doubt both European political stability as well as British trading and investment relationships with Europe itself. So the concern is that maybe the British economy will suddenly slow down. Now, the most recent data indicated the British economy was growing at a 2% type growth rate. Now, if you say cut British growth from 2% to 1% because of the Brexit risk, then that potentially could take 0.1% off global growth. But bear in mind that global growth is averaging around 3%. So that's a marginal impact. Say if we took a more negative impact to Europe itself, say instead of Europe growing at 1.5%, we took 0.7% off the growth rate, the impact of that on global growth might be another 0.1%. So really, to be negative on the global growth story, you really need to have a contagion spillover effect from Europe itself to the rest of the world. So in terms of American and Chinese economic growth. And bear in mind, we're only less than 2 weeks since the actual vote. And so far, most of the turbulence that has been created is more in financial markets. We haven't seen any activity data yet to say that global growth is struggling because of Brexit.
And do you think the US Fed is done with raising interest rates this year?
No. I think we need to be careful that at this point in time, the Federal Reserve has decided to keep a steady hand on interest rates. But bearing in mind that the US economy is doing reasonably well, the unemployment rate is below 5%, you can see that inflation pressures are gradually building up. So if you looked at core inflation on various measures, they're between 1.6% and 2.2%. And bearing in mind that the nominal interest rate is below 0.5%, you can see that American interest rates are artificially low. So it's inevitable that we get a rise in interest rates. The only concern I would have is partly the Brexit story and partly the presidential election story. So the Fed may be conscious of that political risk angle, bearing in mind that the Republicans in the US have been quite adamant about Fed independence.
The Reserve Bank decided not to cut interest rates, but to keep them steady. What led to that decision?
Well, the Reserve Bank is taking a mildly positive view on Australian economic growth prospects. So they can see the recent activity data, which suggests the economy is still growing at a 3% growth pace. But they're also of the view when they look at the consumer spending. They look at the housing market in particular. The housing market in Sydney and Melbourne is quite robust. You're seeing annual gains around 8% over the past year, which is very encouraging. They've seen the currency come down, sitting around 75%. That's providing some stimulus to the economy. So their view is maybe that monetary policy has done enough so far and that they should keep the powder dry on interest rates until necessary.
So do you think we're done with rate cuts for the rest of the year?
Probably yes. You would need to have a very surprisingly low inflation results for the June quarter. So that comes out at the end of July. And if you had an annual inflation number, say, below 1%, maybe there's a case for the Reserve Bank to cut interest rates in that environment. Or if the Australian dollar surged. So if the Australian dollar went closer to 80 cents against the American dollar and therefore put some downward pressure on prices, maybe there would be the case. But I don't think it's a compelling case at this stage.
Bob Kineen, thanks for your time.
Thank you very much.